Hello, and welcome to a new episode with your host, Vinney Chopra. I'm so excited to have you here as we dive deep into the world of real estate investing, syndications, abundance mindset, and building generational wealth. We are excited to be in the top 1.5% of the real estate podcasts. Got number 11 actually out of top 50 real estate syndication podcasts. Thanks to you. Each episode, we bring powerful insights, expert guests, and actionable strategies to help you take your investing game to the next level. Whether you are a seasoned investor or just getting started, if you love what you hear, please take a moment to subscribe, leave a 5-star review, and follow me on social media so that we can never miss an episode. Your support helps us continue sharing valuable content with more people like you. Now let's jump into today's episode. Thank you. Good morning. Good morning. I'm so excited that brother Amit Chandan is here in the studio with me. Actually, he's been on my podcast few other times. If you just Google Amit Chandan and also Vinney Chopra and YouTube or like that, you will come across the older views. Today, I'm so excited because this is 2025. The key thing is the stock market is going up and down and up, and mortgage rates are stuck where they are. They are not going down. So when Amit reached out to me, I was so happy that he could come in the studio and kind of share what's happening in the stock market, how this quarter second, just now, Q2 just finished, and the stock market is going higher and higher. So lots of my followers are into diversified assets. I'm so excited to have him on board. He's a engineering graduate plus MBA plus PMP, just a great teacher, also like a student of finance, as he and I were discussing. When I teach my lessons, I become a student also. Amit, thank you. Thank you so much for joining, Amitji.
Thank you, Vinney ji. It was very nice to have you, to be with you. This is, I think, a third or fourth time that we're doing this.
Yes,
and
yes.
I have a community of people who also follow me. We have our own Telegram channel where we discuss finances and the stock market. And we're at a very interesting juncture at this time. One of the things that everybody's hoping for is they are hoping for the mortgage to go down or the mortgage prices to go down. But as many of you know that I teach about the stock market, do you know there is a very interesting connection between the stock market and mortgage rates? So I wanted to discuss about that, but certainly I'm going to start off today's webinar with showing how the stock market has done year to date, which sectors are up, which sectors are down, how does seasonality come into play, what do we expect based on historical patterns in August, September timeframe. Then I'm going to go under the hood to show you what's heating up the market. And lastly, before I talk about the mortgage rates and their relationships, I will then talk about what's been happening with a big elephant, I call it, which is the healthcare sector and why that is.
Yes.
Okay. So I'm just going to share my screen.
Thank you.
So this is the performance of the stock market as of yesterday. And it shows the behavior of different indices since the beginning of this year, which is basically, it means year to date. So you'll notice that S&P 500 as of yesterday had gained 8.21%. Let me put an ink on that. S&P 500 has gained 8.21%. NASDAQ, which is represented by the index called NDX, was up by 11.5%. This is year to date. Dow Jones Industrial 4.25%, and Russell 2000, which is small to mid cap companies, at 0.44%. Now, I want to zoom back or rewind ourselves to the month of late March, early April. Remember what had happened. The market had taken a huge downturn. And at that time, people were thinking, oh, the market's going to crash. The world is going to come to an end. Guess what's happened? Ever since then, the stock market has gone up. And in fact, since then, the S&P 500, which means since the April lows, the S&P 500 has gone up by 32%, and NASDAQ has gone up by 41%. So for all those people who've been listening to my webinars in our community, which is Informed and Invested, and you can search that up on YouTube, you'll realize that we were going through the reasons why the stock market had gone down. And at that time, this was the judgment day, as we call it, right? So President Donald Trump was going to implement tariffs. So what happened at that time was a whole bunch of importers started going in, became nervous, started importing more goods, which also affected the GDP because the net imports went up. Anyways, I'll talk a little more about that. But there were reasons behind that. It's not that the fundamentals of the companies were weak. So when the fundamentals are not that weak and the market goes down, typically, what does that mean? It typically represents a short-term emotional or erratic reactions of investors. Nothing else. But people like me and many other who know what to buy, we're buying. And I'm happy to say at this time, my portfolio is making good money. Me
Yep.
and many
Sure.
other smart investors are very happy right now.
Yep.
So this is a chart that I've gotten from FinViz, and it shows a grouping of sectors and how they have behaved since the beginning of this year. So you'll notice that since the beginning of this year, technology has done really well. And by the way, if you zoom out or rewind yourself a year or a couple of years, you'll notice technology was not doing very well. Now technology is doing well, which in the world of investment is called cash rotation. So anyways, technology is done the best, 13.85% year to date. By the way, that also is analogous with what NASDAQ has done. And remember, NASDAQ is a collection of mostly technology stocks. 13.85% followed by utilities, then industrials, basic materials, financial services, consumer defensive, and communication services. And the worst performing sector has been healthcare. And I'm going to speak more about healthcare later, why it is down. But yes, it's the most unloved sector at this time, down by 12.08% year to date as of yesterday. And then other poor performing sectors were consumer cyclical, energy, real estate, etc. And real estate, obviously, we know the mortgage rates are coming to an effect, and I'm going to discuss about that today. And I specifically want to talk about that, Vinney, because you have such a strong concentration in
Yes.
real estate. So
Yes.
I thought
Yes.
this would be a
Yes.
good
Uh,
topic to talk about.
Thank you.
I want to talk about something more seasonal and a potential reason for caution. So, what do we think August and September may turn out? We noticed that there was recently the stock market started to become a little volatile after having a very strong run up. So, what does the history tell us? I have two charts here, the top of which, or the one above, says or shows S&P 500 average monthly returns from 1950 to 24 in the month of August, September, along with every single month. And it breaks it down by different colors. So the gold color represents all performances by different months since 1950. Then you have past 20 years in blue, past 10 years in green, and then post-election year, which is this year, post-election year. How did that work out? So have a look at this. While typically, historically, the market performs fine in different months, specifically in August and September, notice the market is down. Now, this is not stuff that I have created. These are historical averages. So what it shows is, especially the post-election year, if we look at the black portion, this is more related to our time right now. August and September are not necessarily the best months. And we're also noticing a volatility right now. Is that going to play out? Nobody has a crystal ball. We'll have to wait and watch. The second chart, which is the bottom, shows the performance in August. And when in August? During the second term of the post-election year. So second term is this year of President Donald Trump. He's already been elected once. This is his second year. So how have the performance of S&P 500 been in this kind of a situation over the last 50 years? So have a look. 1957 was the second term of President Eisenhower. In August, S&P 500 was down 5.6%. Then we have Nixon in 1973. S&P 500 was down by minus 3.7%. Then Reagan in 1985, 1.2% negative. Clinton's time, minus 5.7%. Then George Bush, President Obama, and now time of Trump. What is it going to be like? We're going to have to wait and watch. But so far, if you are looking at history, August has been finicky and has not done really well. On average, August during this kind of a situation has produced a minus 3.4% return. Okay? It is what it is, but I'm gonna come a full circle and explain a few more things to you. Now, here's something that's very interesting that has happened. Do you know that the S&P 500 has been above the 20 simple moving average for 68 days? So I'll put it another way. If you look back over the last 2-3 months, you'll notice the S&P 500 has just been growing, right?
Just going up. Yep.
In April, it had hit an all-time low, and then people were very skeptical that, oh, how can this be going up? Maybe it's a dead cat bounce. It's going to ultimately go down. And it's a typical story. When market goes down, people take money out and they don't invest back because they want it to go further down. They don't want to lose as much money.
Yeah.
And oftentimes people don't get back in. This is why I say it's wise to stay invested. But nonetheless, this line here represents the 20-day simple moving average. And you'll notice ever since late May, the stock market has been above this 20-day simple moving average until last Friday. Last Friday, for the first time in the past 68 days, did the S&P 500 go below the 20-day simple moving average. Is that bad?
Wow.
Is that good? Let's have
I
a
don't know.
You don't know. So, Vinney, you know that the stock market or any kind of investment for that matter doesn't go up in a straight line.
No.
Right? That's just how it is. So market always goes like this, up and then down, up and then down. Like it runs up, then it takes a breather, runs up, then takes a breather. That's just how it is. Now, human tendency or personality is that when market goes up, everybody's very happy. But the moment it goes down, they're like, what's going to happen? He's going down.
Yeah.
So again, market's gone down. So does it happen normally? If you look back historically, as I mentioned, market never goes up in a straight line, goes up and down. And typically market finds a support at a 20 moving average or a 50-day simple moving average. These are very normal. If it goes further lower than that's also normal. And I have historical charts that maybe we can discuss in the future time, which shows how many times a year do we expect a 5% correction or a 10% correction or a 20% correction. There are historical patterns on this. Does it always follow the same pattern? No. But what's important to remember is that this is a normal behavior of the stock market. Just because the market takes a dip, it doesn't necessarily mean that it's time to sell. It may be time to think that, hey, if you're a smart investor, it may be an opportunity for you to enter stocks or companies that are at good price. But you have to know what to buy. There's a whole lot of science and math to that. But ultimately, just because the market has gone down, it doesn't mean that this is necessarily something to panic. But why I have this chart here is because there have been some historical studies done on this. And what are those historical studies? It's right here. S&P 500, there is a research that has been done by Carson, and it's based on different times in the history since 1950 when the S&P 500 had remained above the 20-day moving average for at least 60 days. And then it went down. What happened after that? Okay. So in 1961, the S&P 500 was above the 20-day moving average for 94 days. And then it dipped. What happened thereafter? After that, 1 month thereafter, the market was up 1.6%. 3 months after that, minus 1.4%. But 1 year after that, market gained 4.1%. Now let's go down the whole sequence. In 1964, S&P 500 was above the 20-day moving average for 101 days. Then in 65 for 70 days, 61 days, 60 days. And most recently in 2025, S&P 500 was above the 20-day moving average for 68 days. Historically, 1 month after, when something like this happened, the market gave an average return of 0.8% in the next month. 3 months after, 3.7%, 6 months after, 2.9%, and 12 months after, 10.8%. And 12 months after, full year after. Now I want to bring you back to this specific slide. Here, what I was talking about was the average behavior of the market in August and September, and the market behavior in the second term in August. That's what I was talking about. But this chart talks about when the market remained above the 20-day simple moving average for over 60 days or at least 60 days. So they're slightly different. And there may be a contradiction that, hey, 1 month you're saying that average return is 0.8%. And previously we were saying that typically August and September are bad. It just so happens that both coincide at the same time. The 60-day could have happened at a different time as well. But they just so happen that they coincide. So we don't really know how August and September will turn out. And ultimately, it's also not our chance to, it's not wise for us to start guessing. A smart investor bases his or her investment decisions on fundamentals, on fair market values, being able to put that into perspective from hopefully a mathematical point of view. That's how you invest. But these are good because what they do is they give us a way to base or anchor our thinking that just because the market's going down, maybe it's seasonal.
Yeah.
Right? That's why I'm saying maybe it's seasonal. That's why I have a disclaimer here. The past performance is not a guarantee of future success.
Yeah.
Now, I also want to zoom out and take a look at the longer term pattern of the S&P 500, especially in based on the presidential election cycle. So again, this is a research done by Carson, and it shows that in today's election cycle year, where has the S&P 500 come in? So the black line here represents the behavioral pattern of S&P 500 from 1950s based on election cycles. And which is that? It's a post-election cycle, post-election year, and how it behaves. So you notice the black line is the historical pattern, and the blue line is exactly where the S&P 500 is this year. And we are right at this point, early August.
Wow. Wow.
I'd love to say that I had done this research. I didn't. I think some other smart people have done this research, but I think it's very relevant because I have been following these kinds of charts in the past, and my past webinars for people who follow my YouTube, they would have watched these. But here's how the S&P 500 has behaved compared to the historical patterns. Notice from April until August, historically, the stock market does fairly good. And that's also what we have seen. Now, historically, the market doesn't dip as much in April, but the reason it dipped is because of Donald Trump.
Yeah.
And his, what do you call
Tariffs.
that? The Judgment Day.
Yeah.
So this is why it dipped. But otherwise, the market has behaved fairly standard, right? Like notice from January to March, it goes up and then goes down. Something similar happened, goes up and goes down. And now it's going up. The percentage of ups and downs, obviously, those are not going to be the same. But generally, the market has behaved fairly well. Now, historically, this also shows that August to September is a volatile time. Market typically stays sideways or slightly goes down. There are many people who follow me in my Telegram channel, right, where we discuss investment. So there are a whole bunch of like-minded individuals. And a lot of them were saying earlier this year, hey, Amit, I lost out on this big wave up that went. And I was telling people, I'm like, guys, don't forget, things don't go up in a straight line. What goes up comes down. And it's a cyclical, it doesn't follow a straight line, essentially. And I'd also mentioned that seasonality often comes to play. So stay on a lookout. It doesn't mean that we make our trading decisions based on that. Again, that's why I'm saying past performance is not a guarantee of future success. But again, it helps you anchor that 2025 has followed that playbook almost perfectly. Solid gains have happened earlier this year. There's been some choppiness and consolidation in Q2. And now in Q3, that's going to continue. And if things were to play out based on the pattern, there is a possibility of the stock market giving additional returns later this year. Exactly what's going to happen, we don't know. And I'm also not saying that this be a trading signal, but these are historical cycles that help us frame our expectations. Now, moving forward, I want to show you that all this rally that we've had, why have we had this? Because if I look a few charts below, the market had dipped and had taken a big dip. A lot of people are saying, oh, this is going to be a recession and this is going to be the greatest recession since Great Depression. This kind of story keeps coming up over and over again. But let's look under the hood. Here, I have two charts that show the performance of S&P 500 from the viewpoint of forward 12-month profit margin expectations and from the next 12-month earnings per share. So you'll notice that in 22-23, when the market had taken a dump, and this was a dump from the profit margin point of view as well, you'll notice that ever since then, the profit margins of the companies in the S&P 500 have actually been increasing. And right now they're sitting at an all-time high of, or at least they're sitting at a high ever since the 2019 at a 13.8% returns from a profit margin point of view. And when you look at the EPS, the earning per share expectation based on forward earnings, you'll notice that the earnings per share are currently sitting at $284. In fact, they have already beaten the 2025 expectations.
Wow. Wow.
These are actual numbers. This is how it's happening. So right now, the EPS is sitting at 284, and that's already beaten 2025 expectations. And guess what? It's coming close to the 2026 expectations.
Wow. Wow.
And to support that, I have here the quarter two earnings scorecard of the companies in the S&P 500. And this chart has been produced by FactSet, FACTSET. And what they do is they track how the company's earnings have been coming in, and then they classify them based on different sectors. And then they see how many companies percentage-wise have beaten expectations, which is represented by green. How many companies have not beaten expectations, which is represented by red, and how many companies are in line with expectations, which is represented by yellow. Notice that technology, 97% of the companies have beaten expectation.
Wow.
And this is Q2. Q2 just finished. In communication services, 92% of the companies have actually beaten expectations. Financial services, 90. Real estate, 84. So even though real estate or REITs are down from the stock market point of view, look, the companies are doing really well. What does that show you? That shows the fundamentals are strong. And if the fundamentals are strong, ultimately the stock value catches up.
Stock will go up. Yeah.
Because the fair market value of the stock is here. So ultimately it gets there. The current stock price that you're seeing is not the same as the value you're getting out of that stock. So that's where I often say the price is not equal to value. The value is the fair market value. And the price that you're seeing is the current stock price. That's based on emotions. So short-term movement of the market is based on emotion, but ultimately it would reach where the fair market value is. Moving forward, consumer staples, 83%. And right in the middle is the average S&P 500, which shows that 82% of the companies have actually beaten expectations. And the laggards were material at only 44%, then energy, utilities, et cetera, et cetera. Now, let's carry on supporting this view. I have two charts here that talk about valuation of companies. Okay, because that's one of the things that a lot of investors are obviously a little uneasy about. So the top chart shows me the forward PE ratio, so price to earning, but the forward price to earn, the price based on forward earnings. Okay. And the one below it shows the price to earnings per growth. So PEG ratio is price to earnings divided by the growth expectations. But these are expectations. So here's the thing. And I had to, by the way, I wanted to superimpose both charts because I wanted to show them in a bigger size so you can see. And that's why I made the one in the front a little transparent so you can see what's happening in the back, because I'm going to talk about averages. So when you look at the price to earning, which means what is the price of a stock based on the earnings, when we compile that for the whole of S&P 500, this chart comes up, which is showing up here. And it shows right now that the S&P 500's price to earning ratio is 22x, which I'm not going to lie to you, is on the higher side. So if you simply go on based on the price of the S&P 500 based on the earnings of all the companies, S&P 500 is right now sitting expensive. Because the average PE ratio is supposed to be somewhere around here. And if you compile that, it typically comes out to 17 times, which means the stock of the price of the S&P is 17 times the earnings. Right now it's sitting at 22 times. So like I said, that shows that the S&P 500 is expensive, but is it really? Just so happens there is another ratio called PEG, which I just talked about. So price to earnings, because price to earnings can be justified if the growth is very high.
Yeah.
So if you were to divide the price to earnings with growth, you get a PEG ratio. And what this does is it starts to put everything in. It starts to do an apples to apples comparison, because it says If the growth is very high and the price to earnings is very high, then the PEG ratio comes down. Remember, when the denominator goes up, the numerator, the overall equation comes down.
Yep.
So in this case, when you divide the expected growth rate of the companies within the S&P 500 and divide that by the price to earnings, the PEG ratio turns out to be around 1.4, which, if you look, remains in the average. That means when you look at the PEG ratio, S&P 500 is not expensive. Even though the companies have been growing in power and growing in stock prices, because of the growth expectations, it's looking like it's fine.
Yeah.
So if we look from a valuation point of view, what it tells me is that we as investors are not necessarily in what we call a bubble territory. Okay. As long as the earnings keep growing, the PEG ratio will remain fine and the growth of the stock market can be justified. But with that said, because we are close to an average, that also shows that the margin of error right now is very small. So any kind of disappointments, be it from Feds, be it from inflation, be it from geopolitics, the stock market can be punished for that. So it basically means that the right move here at this time is to stay invested. Don't panic, but it's wise to be selective. Also, it's wise to be selective because there is volatility in the market, at least historically, in August and September timeframe. Now, in one of my webinars, I spoke about why markets are rallying in 2025. And these are, I talked about 5 tailwinds. So what are these tailwinds? I'm going to briefly touch on those right now. So first tailwind is the big, beautiful bill that President Donald Trump has come out with. Now, for those of you who haven't watched, please watch a couple of my last webinars where I discuss in detail what these bills are, why these kinds of infusion packages are actually good for the economy, regardless of what other people are saying, as long as the country puts that money to wise use. Because there are some other countries who get these kinds of infusion packages and their politicians just gobble up all the money. So as long as things like that don't happen, stimulus packages can be very beneficial. So I speak about that. But essentially what's happening in summary here is there are tax cuts proposed. There are also 100% expensing for depreciation, which could be very valuable for a person such as you who's in real estate. And also a lot of deregulation.
Deregulation will help a lot too. Yes.
Exactly. So when that happens, the reason that could be good for the companies is because the companies are going to be able to increase their profitability by expensing more. When they increase their profitability, that affects their fair market value. Also, tax cuts will put more money in the pockets of people so that they can spend more in purchasing products from companies. And when that happens, the revenue goes up and ultimately the profitability goes up and the valuation goes up. So it all goes to help companies. So President Donald Trump is a businessman. Obviously, the bills he's going to come up with are going to be pro-business. And this thing has all of that written all over it. So that's going to be good for companies and ultimately good for the stock market. Second is rate cut expectations. Now, these are rate cuts from Feds, not mortgage rates. I'm going to talk a lot about mortgage rates today, but these are the short-term rate cuts that the Feds are going to have. They have not pulled the trigger yet, but the market is still expecting some rate cuts to happen. And that's helping the growth stocks and valuations to stay elevated. The third is a weaker dollar. This has been a tailwind, obviously, specifically for US multinationals. I'm going to speak more about that when I talk about the dollar index. But what it does is it boosts export competitiveness of multinational companies that are in the United States, and it basically converts into foreign translations or foreign companies that can now purchase US products more because the US dollar has gone down in value. But then it increases the revenue of companies in the US, which grows their value. Again, shoots the market up. The fourth tailwind is stable oil prices.
Oil price.
Hi friends, this is Vinney Chopra from here in Danville, California. And you might be saying, hey Vinny, what are these over here? You know, I wrote this book a few years back Apartment syndication made easy. It became top seller. I came from India with $7 in my pocket. It says 500 million. It's going to be 1 billion very soon, very soon. I'm right at about 850, 900 million. And then I'm ready for the next billion. Actually, you will see that happening, 2 billion in this book also. The other book I wrote, which has been a very big positivity, has been my life. Always, I've been married 43 years with 2 children. And the beauty is to be positive, the mindset that can take you to all the places in the world. And that's the book that also became big seller. My third book, Senior Assisted Living, is coming. So do yourself a favor. Go ahead and click the link below to get free copies, audio copies of these books, even printed copies of these books. Printed means digital if you can't afford it. But I would highly recommend for you to get these, or go to Amazon.com. Just go to Amazon. I got it in soft cover, in hardcover, in Kindle, in audio, also the Spanish version of this book also. So let's crush it, guys. I know you can be successful. I know you can do the kind of things that you want to do in life and have the streams of income and know how to really, educate yourself so that you could become a strong force in this world in real estate. I know you can. So take that step. Don't just be on the sideline. Take charge of your life. Take charge of your education.
Yeah.
Now, I understand that oil prices they're not necessarily cheap yet. They're still around $70, $75 a barrel, but they are meaningfully low compared to the 2022 peaks that happened. So what that has done is it has helped ease inflation pressure, ultimately giving Feds a breathing room. This is one of the reasons the Feds are not necessarily cutting rates yet. So it's good news for input costs into the economy. So in that context, oil has been a supportive force for the market. And the last thing that has been a tailwind for the rally in the stock market are solid earnings. I already showed you the Q2 earnings. They actually came out better than the Q1 earnings. We're seeing the margin and the earnings per share revisions move higher because of that. So that's ultimately also helping. So these are quickly, I want to touch that these are tailwinds that are helping the stock market go up. That's good for investors, not so good for mortgages. And I'm going to explain that soon. So FOMC meeting, which is the Federal Open Market Committee meeting, it happened last week, which is between the 29th and the 30th of July.
Yeah.
So they happened last week between 29th and 30th of July. And Feds have decided to keep the overnight lending rate stable. So notice earlier was going down, but for the last while, it's just been very stable. Yeah. And it's stable at what? 4.25 to 4.5%. Now the question is why? Why have they not done anything with this? Because while inflation has cooled, Vinney Ji, especially the CPI and PCE, the core inflation in services and the housing is still sticky.
That's high.
Feds want to see a broader, more sustainable inflation trend before cutting this overnight rate. So the committee wants to achieve a maximum employment rate and inflation rate at 2% over the long run. That has not happened. In the next slide, I'm going to show you that. Also, the economy is still growing. So if the economy is still growing, Fed's like, why do I need to cut interest rates? Everything seems to be hunky-dory with these rates.
Yeah.
That's why they're being patient right now. So I'm going to talk about mortgage rates now, because a lot of people think the mortgage rates move directly with the Fed's overnight rate. But the fact is very different. It's actually not true. Mortgage rates are actually more closely tied to 10-year Treasury yield, not the Fed's fund rate. And here's why that matters to us. The 10-year yield reflects what investors expect about the future inflation of the economic growth. So it's not what Feds are doing today. Right now, investors believe that inflation could remain elevated. And why? Have a look. I have a chart here. So this chart at the bottom shows. So this chart at the bottom shows the PCE, which is right now sitting at 2.8%. Just a moment. My pencil stopped writing.
No problem. No problem.
It's still not writing. Oh, it is writing. Oh, maybe I can't see it here. Okay. So the bottom chart here shows the PCE. Here is the PCE, and it's supposed to be at 2%. Notice the PCE is above it. Investors are watching this. They're saying, wait, if the inflation carries on being strong, and we know that when the inflation is strong, companies can charge more to their buyers. And when companies charge more to the buyers, the value of the company grows, and in essence, the stock market grows. So they're saying, why would I invest in the 10-year treasury when I can invest in the stock market, because we know stock market is going to make more money? That's why instead of putting money in the bond, which here's a 10-year bond, instead of putting money in the bond, investors are actually putting money in the stock market.
Yeah.
And another thing they're putting money is the money market funds. And money market funds are directly tied to the short-term treasury yields, which is controlled by the feds. So they're putting money here and not in the bond market or the long-term bond market. When they don't put money in the long-term bond market, guess what happens? The demand goes down, right?
Yeah.
Because they're not putting money, the demand is down. When the demand is down, the price goes down.
Yeah.
The bond price. And we also know that the bond price is inversely related to the bond yield. So when the bond price goes down, guess what? The bond yield goes up. And because the bond yield, the long-term bond yield is tied directly to mortgage rates, that's why the mortgage rates are not going down. Now, in whose control are the mortgage rates? Or I should say, in whose control are the long-term bonds? In the hands of people like you and me. Until we are not confident that the inflation has gone down, that the employment rate has gone down, people are going to keep investing in the stock market, and the mortgage rates are not going to come down. That's what's happening. For the mortgage rates to actually go down, what's got to happen, Vinney Ji, is the bond yield has to come down.
Bond yield has to
The
come down.
long-term bond yield has to come down. Now, let's do the same math and reverse this up. For the bond yield to go down, okay, for the bond yield to go down, the price has to go up.
Yeah.
And when will the price go up? The demand goes up. When will the demand go up? When people start investing in long-term bonds. When will they invest in long-term bonds? When the stock market, when they believe the stock market is not doing well, or the inflation is going down, which means the purchasing power of bonds in the long run is going to go up. That's when that's going to happen. This is why the market rates have not gone down yet. Now, let me link back to the second part, which is the money market funds, to teach you about the money market or explain to you why there is money in the money market funds. Let's talk about GDP first. So here I have a chart that talks about the recent GDP from 2 quarters. The first chart is a chart that I had in my webinar that I did a couple months ago after the Q1 results came out. And the second one is from 2 days ago, after the second quarter results came out. So in Q1, we noticed that the GDP was negative. Now, if you go back to the stock market, you notice the stock market also started to do poorly because the GDP came out bad. And people who don't know what to look for, they look at GDP and say, oh my God, the market, the world is ending. Let's sell, let's run away. And at that time, I ran this webinar, and there's a slide I got from there. So I copied and pasted the slide because there is another agency in the United States. It's called Atlanta Fed. And Atlanta Fed does real-time tracking of the GDP. So while the Q1 results came out negative, this is what the real-time GDP was saying. And I spoke about this with my YouTube followers. So on April 30th, the real-time tracking of Atlanta Fed for GDP was 2.4%. Not negative, positive 2.4%. And then in May, it was at 3.8%. And then at the end of June, it was 2.9%. And guess what? At the end of June, which is the end of the second quarter, and the results came out at what? 3%.
Wow.
See, the numbers are connecting. Now, why did the Q1 GDP come down? Was the market actually doing poorly? No, market was not doing poorly. That was a result of the increase in net imports from US importers who found out that Donald Trump was going to increase tariffs.
Yeah.
So they said, all right, before he does his tariffs, let me buy as much material as I can
As
from other
much as,
countries.
yeah.
So I don't have to pay that much money, because ultimately when he increases tariffs, it actually hurts US
Expensive.
consumers.
Yep.
Okay. So that's what happened. And by the way, on that topic, when President Donald Trump increases tariffs, right, he's trying to use that as a negotiation tactic with other countries. But do you know, US consumers also get hurt? Why?
Totally.
Because US
They will
consumers
end
have
up
to pay
paying
more.
more. Yeah, they'll end up
And
paying more.
inflation increases, because fundamentally, what is
Yeah,
inflation? Things getting more expensive.
more expensive.
And when things get more expensive, guess what? Stock market goes up. So
Yeah,
all of us who invest in stock market are doing fine. But those people who want to buy a home, they can't afford it because mortgage rates are also up.
so
So
true.
while some protectionist sentiments can help economies, there are also negative sides to it. And also then there's a whole lot of discussion that people can have is, are these increased tariffs justifiable? Of course, protectionist sentiments exist, which is that it's going to boost local production. But for that, the local production houses have to be available as well, and it takes time to set those up. So anyways,
Sure.
that's a discussion, topic of that's a topic of different discussion. But ultimately,
Yeah,
I wanted to show that the GDP is increasing. Now, because the GDP is increasing, that is what's also telling the Feds that, why do we need to cut the interest rates? Things are looking fine with their current interest rates.
right.
Now, because these interest rates are high, which means short-term interest rates, that is connected with the money market funds. And I'm going to talk about soon how people are still investing in money market funds and taking advantage of that. And because they're investing in money market funds, they're not investing in the long-term bonds, which affect mortgage. And they're also
Yes.
not necessarily, there's a huge chunk of cash sitting away from the stock market waiting as a fuel. Let me discuss that in a bit, but let me come down to the second tailwind I spoke about, which was the dollar cost, the dollar index. So here's the US dollar index. It's represented by this ticker called DXY. What's interesting is, and I mentioned that this is one of the tailwinds. So what's interesting is, right now the US dollar is sitting at a low point. So it's landed somewhere soft. But if you turn on some YouTube, you'll notice they'll say, oh my goodness, the US dollar is crashing. Maybe some other countries are going to come and pick it up. Okay, let's not get into politics, but let's be realistic. Here's the performance of the US dollar zoomed out from 2006.
8. Yeah, 6. Right.
In
Yeah.
2008, I took a dip. Notice the performance of the US dollar has followed a very nice support. It comes down, and it did that many times. It came down to this level in 2008, went right back up. Then it did in 2011, went right back up. 2014 went right back up. 2021 went right back up. 2026 or 2025 seems to be going right back up. So, first point, let's not panic over US dollars. The second point is that this is good for US multinationals because their revenue is going to grow. Why? Because the foreign countries that are purchasing products from these goods and service from these multinational companies, for them, the prices of these products is going to go down. So they'll buy more. When they buy more, what happens? The US companies make more money, and then their valuation goes up. But on the flip side, a weaker dollar can also be inflationary, which is why the inflation is still remaining sticky. And how is that inflationary? This is how. It specifically comes down to imported goods and commodities. So anything the US is buying is now looking expensive.
Yeah.
So while it's helping the stock market, it's also causing the Feds to remain cautious at this time. So we've got to balance both. As investors, we should be aware of both things that are happening. Bottom line, this is good for stocks for now. And it's also one of those tailwinds I talked about, right, for the growth of the stock market. But this could become a headwind, which means it could become a friction from the growth for Feds to lower the overnight lending rate, because it has a potential of flaring up inflation. All right, heading back to that concept of money market funds. So remember, I was telling you that short-term rate is something that can be controlled by the Feds. Long-term is controlled by investors like you and me. What's happening right now, because the Feds have kept the interest rates elevated, means the money market funds are also elevated. So Fed fund rate is at 4.25 to 4.5%.
Right.
As a result of that, the money market funds are giving somewhere close to 5% return.
Yeah.
This amount of return is very attractive for cautious investors. And who are cautious investors? They could be institutions, they could be retirees. And they're saying, if I'm getting 5% return, let me just take that. Let me not worry about the figuring out how the stock market works, or let me not worry about the long-term bonds. So money market is getting money which otherwise would have gone into the stock market and the long-term treasuries,
Sure.
which then affect the mortgage rates. So there is less money there. What these people are actually doing right now is they are waiting for a direction or some kind of clarity, either from rate cuts, which would make the money market less attractive. So if the rate cuts happen, this is going to become less attractive. And then what's going to happen? Money might flow into stock market or into long-term bonds. And that's a good thing. Or they're waiting for a stock market correction. So if the stock market falls, then they'll say, okay, we know in the long run stock market's good. We missed out on this run. Let me take some money and put in the stock market. That can happen. What that's going to do is it's going to boost the stock market and hence a tailwind. Or they're looking for a buying opportunity into bonds. So when the yields look better. So if somehow miraculously the yields go up in the long term, they'll put money in there. But this is what's happening. So
Wow.
this is not a vote of
This
confidence. Oh, by the way, do you know how much money is sitting in money market funds right now?
No, how much? How
As
much?
of last week, 30th of July, $7 trillion is sitting.
Oh my gosh. Oh my God. I knew it was a very big number. Thanks for sharing that. 7 trillion dollars.
$7 trillion. I often hear people say that, oh, put money in like this kind of an investment, that kind of investment. Vinny G, there is a lot of investment in these kinds of portfolios, which consist of liquid cash like stock market,
Yes.
money market
Yes.
funds, bonds. There's a huge amount of cash.
Wow. Wow. Which can be put into real estate, into other stuff. So many other places it can go to. Depends on the what is going to happen in August, September, October.
Yeah.
Wow.
Yeah.
Wow. What a
Now,
tremendous presentation. I'm so thankful for you to really do this, Amitji. This is amazing. And I would love, let's go next one. And then how
no,
can people
absolutely.
reach you and they can follow you?
It's a lot
Because
of
you are,
fun because you notice how the interrelations.
yeah,
It's not just one thing is doing here, one thing is no, they're interrelations.
no,
And to be able
it's
to
all
understand these
interrelated.
interconnectivities, right? When
Yeah.
you then read Wall Street Journal or some smart person in a news channel,
Mm,
like you're going to
mhm.
be able to understand. So that's what I'm trying to explain, that this is what's happening under the hood.
Yeah, very nice.
So last thing I want to discuss with you is
Yes.
what's happening to healthcare.
Healthcare. Yeah.
Is it broken? Are people in the US going to be out of healthcare? Are these companies going bankrupt? There's a whole sector out of whack right now. What's going on? Let me
Wow.
touch on that. This
Wow.
is a question that comes up in my Telegram channel a lot. So I decided that for my webinar that I just did yesterday live, that I would have this so people can ask me more one-on-one questions. So here's what's going on. Healthcare sector, whose ETF, if you want to just track the whole sector, its ETF is XLV. And if you go into
Mhm.
TradingView, which is a free website, and if you just say in the ticker, you type XLV/SPY, what it will do is it'll give you a chart that shows a relationship of XLV in relation with the SPY, which is the S&P 500 ETF. And when I do that comparison, this is the chart that comes out. And it shows the performance of the healthcare sector in relation to S&P 500 ever since XLV has been in existence, or the SPY has been in existence, vice versa, or one or the other. And you'll notice right now, Viniji, that in 2025, the XLV compared to S&P 500 is sitting almost at the same level as the dot-com bubble,
Wow. Wow.
1999,
Wow.
2001 levels. So one side of looking at this could be that, oh my goodness, this is so bad. Let's run. This market is crashing.
Yeah.
The other could be that smart investors, they could view this as an opportunity. That from here, there may be a run all the way till here, some point in time. But you have to know what to look for. You can't just invest in any kind of stock. But I want to show you that this is what's happening. Is the sector broken? To answer that, the question you need to ask yourself, is the healthcare sector going to be needed in 2 years, 3 years, 5 years, 10 years? If the answer is yes, then maybe the sector is not broken. Maybe it's just
Totally.
out of favor right now. Remember,
Yeah.
technology was out
Yeah.
of favor a year or a couple of years ago, not in
So
favor right
true.
now. So it just means that it's out of favor. But the healthcare sector, Viniji, is not one story. It's actually a combination of multiple stories. Healthcare sector consists of many things. It consists of life sciences, healthcare equipment, pharmaceuticals, biotechnology, and healthcare providers and services. So we have a whole bunch of different ETFs that track those specific subsectors within healthcare, and I have charted them all in this following chart. So you'll notice that life, which is the life sciences tools and services, this consists of companies that provide lab equipment and diagnostic products, such as Thermo Fisher. Guess what? Year to date, that part of the
They're going.
healthcare has not done
Yeah.
poorly. It's actually up
Yeah.
20.72% as of yesterday. And that's
Wow.
very good.
Wow.
The second sector is IHI, which represents healthcare equipment. And these are medical device companies and diagnostic companies. Look at this. It has done 3.57%.
Wow.
Then pharmaceutical sector is actually down 1.27%. Biotech is down 1.9%. This is XLV is the overall. This is the overall XLV sector. And within this, the worst performing is the managed healthcare, which is represented by the IHF. It's down 13.75%. This
Wow.
consists of health insurance, hospital networks, distribution networks, and companies like United Health. So
Oh.
this isn't about that healthcare is broken. Healthcare is absolutely not broken because look, some sectors are doing really well. Health life sciences has given you 20.72%. It's
Yeah.
actually about one major segment that is under pressure, while others have been quietly doing very well or relatively doing okay. That brings me to the next part, that why did healthcare, especially the managed care, fall so much?
Mm-hmm.
So, this is part of a big story. So, I'm going to tell you the story. It all started with COVID. So, when COVID started, what happened was the hospital started concentrating on COVID cases and they started rejecting elective surgeries. So, they started canceling those elective surgeries. They started canceling healthcare, other diagnostics. What this did was that the healthcare costs actually ended up dropping. And companies or insurers, companies in the insurance sectors, so insurers like United Health, they made a ton of profit because people were not filing claims. But soon after pandemic, people came back and they came back very fast. So surgeries, therapies, elective scans, anything like that, all that stuff that was delayed during the COVID time, it all
Mm.
came in and it flooded the system. The costs jumped, but the premiums of companies like United Health, they were still based on old assumptions.
Mm.
Okay. And on top of that, the Medicare Advantage, which was a huge profit center for these companies, is currently under pressure because of regulatory reviews and obviously add political pressure on that and any kind of pressure on drug pricing. And suddenly the entire sector is starting to face earning compression. It's not a broken model. It's just a mispriced one. And companies like United Health are in the midst of adjusting prices. Their quarterly return just came out, I think, last week. And if you read that quarterly return, you'll notice that they were already created plans of increasing their premiums. And when the premiums get increased, guess what? Their cost pressures are going to start stabilizing. So,
Right.
quick question, as I mentioned already to you, is when you want to look at any kind of sector which goes down, ask yourselves a question: will the services represented by that sector still be needed? And if the answer is yes, then you have a way forward. Okay, folks. And
Makes
Viniji,
total
that brings me to the
sense.
end of this. So, any other questions you may
Ah,
have, I open it
no,
up to you.
thank you so much. I'm so thankful. The whole presentation, I hope people who joined us during or in the middle, please go back and look through. And also my team will be cutting into podcast, also on YouTube channel and Reels. I really want to thank you for taking the time and how much efforts you have put into this presentation. We were discussing it takes many hours, 20 plus 25 hours. That's a lot of time. But how can people reach you?
Oh, it's very easy. Just go to my YouTube channel, search Informed and Invested. I also have a website under the same name, but when you go to the YouTube, you'll find a whole bunch of other videos. In there, there's a Telegram channel. You can just click it and connect. Everything's free. We are trying to bring a change in the world by helping people be informed investors.
Yes. No, thanks again very much. And I hope everybody watching us or listening to us, I hope you like this episode and give us a 5-star review and share this episode with your friends, family, so that they can be more educated. That's what the channel is. Informed and educated. That's
Informed
what
and invested.
Invested. Yeah, informed and invested, because you want to really get your money to grow in stock market, mutual funds, into other alternatives, also real estate, because that's where I usually talk about all these things. So I hope this episode has been really helpful to you. We'll see you next time. Thanks so much for watching. Thanks. Thank you, Amitji. Thank you.
Wow, what an incredible conversation today. I hope you got tons of value from this episode. If you did, don't forget to subscribe, leave a 5-star review, and follow me on social media to stay updated on all the things real estate, investing, abundance mindset, and wealth creation. If you're an accredited investor looking for exclusive investment opportunities, be sure to join our elite Monil Investors Club at vinnychopra.com/invest, where we share details of our future projects. Quick disclaimer, we are not selling any securities, and this podcast is strictly for educational and information purposes only. The opinions shared by our guests are their own and should not be considered financial or investment advice. Always do your own due diligence and consult with a financial professional before making any investment decisions. Thank you again for tuning in. Until next time, keep smiling, keep investing, and keep making a massive impact. God bless you.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to VinneyChopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.